Good afternoon, everybody, and welcome to the Q4 2025 webinar from IRU, Apply, and TI. We'll just give a few more seconds for attendee numbers to stabilize, and then we'll get started. Okay, it looks like attendee numbers have stabilized. So welcome again, everybody, to the IRU, Apply, and TI European Road Freight Rate benchmark for Q4 2025. It's been yet another really interesting quarter in the European road freight market with really interesting dynamics actually at the end of Q4. So we had, relatively soft peak season, but at the same time we have an expectation for a bit of a, I'd say rebound, but at least a better 2026. So there is an anticipation of recovery in volumes, and that's been driving companies to seek to lock in contract rates for the year ahead. So we saw a bit of an uptick in contract rates last quarter while we had quite soft spot rates. So quite an interesting dynamic, which we're drilling down into today. Of course, we also have plenty of background going on in terms of geopolitical upheaval. We've had the whole Greenland situation, threats of further tariffs there, which have caused more uncertainty, though seems to have settled down now, but obviously shows that 2026 is not going to be a settled year either, and there's be plenty of twists and turns to come. So we'll be drilling into all that today and trying to give you a view as to what's going to happen in the road freight market and particularly to rates over the course of the year ahead as we go through the session. We also have some great new data from IRU today. So they'll be sharing lots of interesting insights on tolls and on the cost environment, but also the new data from the driver shortage survey is out. So we'll be sharing some preliminary data on that today. Now we have, as usual, a 40-minute presentation on the data today. And then we'll be moving on to a Q&A session at the end, and we'll try and answer as many questions as we can. But as always, please do ask your questions using the Q&A app during the course of the session, and the team will try and answer as many as possible as we go through the session. We'll also have our poll again today, so please be prepared to answer that towards the end of the webinar. We'll be asking you for your views on road freight rate development in the quarter ahead, which will help shape our discussion of the outlook. And of course, as always, we'll send out a copy of the report and a recording of this session to all participants and registrants after the session is completed. So you'll have a chance to look back in a bit more detail once the session has completed. All right, now it's time to welcome our panelists. So I shall introduce myself as your host. So my name is Michael Clover. I'm Head of Commercial Development at TI. And TI, for those of you who don't know us, is a strategic research and intelligence firm focused entirely on the logistics and road freight industry. So we can help you with any strategic projects you have within the industry. I'm also joined by my colleague, Janan Hassan, who's one of our economists here at TI. Janan has led the work on the analysis for this report. So it's good to have you with us again, Janan.
Thank you, Michael. Hi, everyone.
Thank you. And I'm also joined by Romain Mouton, Research Transport and Environment Manager from IRU, joining us, I think, for his second webinar with us now. So welcome, Romain. And would you like to introduce IRU for anyone who doesn't know the organization already?
Yes, thank you, Michael, and good afternoon, everyone. And for those who don't know the IRU, we are the International Organization of Road Transport. We are based in Geneva, and our mission is to be the voice of transport operators worldwide and to support them for being more sustainable, more efficient, and safer on the roads.
Thank you, Romain. Before I introduce our last panelist, I will just read our disclaimer, as always. So we remind you that all discussions and statements made by participants or commercially or strategically sensitive information may fall within the scope of competition law and be considered as unlawful. We invite you to refrain from sharing any information of such nature or entering into any such discussion, including during breaks. Right, and now I can introduce our final panelist. As always, it's Thomas Leroux, Chief Executive Officer of Upply. So welcome once again, Thomas. Good to have you with us this time as well. And would you please introduce Upply and also talk us through a little bit of the methodology behind the data for anyone who's not familiar with Upply already?
Of course, thank you, Michael, and good afternoon to all. So Upply is a company that we created 8 years ago. We are a French-based company based in Paris, exactly. And we are an intelligent transport management platform. To put it simply, we are very good in managing transport data and taking the core information of what is a transport and then put it in contact with intelligent bricks, it's the intelligent modules. One of the first one that we developed 8 years ago is getting information and knowing how the market is moving regarding transport management and transport rates. And this is exactly the data that we are taking today, data so that we collect for more than 7 to 8 years now. And this is the methodology I will go through with you to be sure that we are all aligned on the data and the rates that you will see in the following slides and in the reports. So first things is that we have a big update regarding data and more will come in 2026. In the last quarter, we added more than 500 million euro of new data, so a spend of transportation in Europe of about 500 million euro. We will add about the same amount in the Q1, and this will continue. We are able to add this data because we are collecting directly invoicing data, transactional data from freight forwarders, from shippers, from carriers, partners. We are connected directly with their transport management system or with their tools, their day-to-day tools. And they are giving us this transactional data, once again, very important because we are talking about real shipments that happen from point A to B with all the characteristics of the transport. We are taking this data and we publish benchmark indexes, dashboarding tools. But for today, we will focus only on FTL, full truckload, for the general cargo, and we will have a view with spot and contractual prices, and the fuel will be included in the data that you will see. Just a last point regarding the methodology, you will see both two kind of information: index, which is usually a 100 base index at a specific point. So when we see 153, for instance, this is not the price, but this is an evolution compared to the past points, for instance, the past quarter. And sometimes you will see also a price with a euro. And here, this is the price for a specific transport from A to B. So be careful on the two because one is the evolution and the other one is the real price of this transport.
Thank you, Thomas. Yes, and really great to see so much new data added to the data set. Just keeps getting stronger and richer for this kind of analysis and to support your clients, of course, as well. So let's move on now to the first content slide, and we're going to look overall at the European picture. So this is our overall European index, which tracks rate development going all the way back to 2017. And we're showing here an index for contract and spot rate together. And Janan is going to take us through the latest trends on rate development at the European level.
Thank you, Michael. So the benchmark index takes contract and spot rates and bases them to Q1 2017. And looking at the indices, we're seeing a divergence between contract and spot rates again in Q4. Contract rates climbed to around 137, a solid 2.6 point increase versus last quarter, and 3.1 points up versus last year. Spot rates reached 135 points, just 0.3 points from last quarter, but down 3.3 points versus last year. And we can attribute the rise in rates in part to retail trade volumes jumping 2.3% year on year in November across the EU. And this sustained consumer demand is driving businesses to lock in contracts now, expecting stronger demand ahead. Operating costs added upwards pressure too. Diesel rose 0.7% quarter on quarter, and driver costs increased 1.3%. Finance and insurance costs also jumped 4.2%. The interesting side about consumption behavior and spot rates, real wages in the Eurozone rose 2.6% in 2025, but household consumption only grew 1.2%. That's half the pace. Households are saving more than 15 cents of every euro earned, and that's the highest rate in 3 decades outside the pandemic. And this cautious behavior kept spot rates from spiking during the holiday season. Looking ahead to 2026, inflation should ease to just under 2%, which is good for purchasing power. A stronger euro and cheaper energy will definitely help stimulate consumption, putting upwards pressure on rates. KPMG expects the Eurozone GDP to grow 1.1%, and that was mainly driven by a 1.3% forecast for consumption. Southern EU economies should continue outperforming, although we're already seeing some slowdown in Spain and Italy. And Germany is set for a considerable rebound, while France should grow just below 1%. The European Commission forecasts overall growth for 1.4% for 2026. So the bottom line is that we expect moderate rate growth as demand recovers.
Yes, thank you, Janania. So we have big expectations actually for 2026 in terms of the demand for European road freight recovering, and hopefully we see that being broad-based, slightly varying across the continent. But as Janan says, there's a lot of growth to look forward to, we hope, in 2026. I think one interesting dynamic which we'll try and drill into a bit later on will be, will this increase in contract rates continue over the course of 2026, or have we sort of seen that adjustment and we're settling in for the year ahead now with that already baked in? So that'll be a big question in terms of decisions on going into new contracts and agreeing new rates. But we'll try and explain a bit more about that as we go into the detail. But our next set of slides is going to be looking at underlying demand drivers and then looking at cost too. So first of all, we're going to look at the volume development, and Romain is going to take us through the latest data from IRU on this.
Yes, and before looking at the figure of road freight volumes in ton kilometers, maybe we can first look at the trade by road during the last quarter of 2025 in tons. And the data suggests a rebound from the low point of August 2025, notably in Germany-France corridor. And at the same time, the data suggests that all corridors linking Poland with Poland are also showing great resiliency for 2025. On the key economic indicators, they are all trending towards increasing road freight volumes for 2025 and 2026, with, as Jen I said, like outselling rates are high, but they are declining, and we see consumption rising more than gross disposable income. Services, retail, construction, industrial production, they are all growing. They all grew during that quarter, and inflation reached 2.5% at the same time. For the full year, for the full 2025, inflation reached 2.5% from 2.6% in 2024. And our estimates give a 2% increase of road freight volumes in 2025 year on year. A growth that should continue this year, 2026, by another 0.6%. And while 0.6 is not that high, this modest growth will allow road freight volume to reach the peak of 2021. Obviously, uncertainties remain, as Michael has said, like we are coming from quite interesting geopolitical tensions the last few weeks. However, there's also positive uncertainties with, for instance, the recent deals between the EU and the Mercosur in South America, and the most recent EU deal with India, greatly lowering tariff for European goods and notably on European cars. And when and if the deals are being confirmed, transport operators can expect a rise of transport demand in the coming years.
Mr. Romain, yes. So some interesting positive messages around the market at the moment. And we're going to turn now to the supply side issues. And first of all, we'll look at the costs, and particularly around diesel prices. And Romain is going to talk us through the latest on that.
And at least on diesel prices, a positive message is still happening. Fuel prices were trending downward in the EU in 2025. The last quarter knew a small bump in November, but diesel prices at the pump continued declining in December, with prices, for instance, in Germany reaching 2022 levels. On average, the price per barrel dropped to $63 in Q4 and averaged $69 for the full year. So the trend, this downward trend is explained by a decoupling between crude oil production and consumption, production being 2.4% greater than consumption. And on top of this extra supply, the dollar is getting weaker than the euro. Looking ahead for 2026, this downward trend shall continue to lower fuel prices for the EU, as the barrel could go down by 9% year on year to reach $56. Producing countries show no sign yet to lower crude oil supply, and we can expect stockpiles to be replenished during the year, notably in China, increasing the gap between production and consumption. Quickly on HVO, as you will be able to read on our report, prices were up in Q4 and are expected to continue climbing. And it is driven by the rollout of the RED III directive, as HVO demand could rise by 8% next year, and the feedstock is still limited. One can expect more expensive prices for the following year. And last word on the future for fuel prices, ETS2, it was planned initially for 2027, and it's supposed to be delayed for 2028.
Okay, thank you, Romain. Yes. So hopefully we may see some further reductions in fuel prices there as the year goes ahead. And that obviously we expect to reduce freight rates over the course of the year as well, if it's passed through. But another area of cost decrease, and actually I've read that this is now becoming, in some countries, almost on par with fuel cost as a cost of operating. We're looking at toll price changes as well, and Romain again is going to take us through the latest on tolls.
Yeah, and here the trend on tolling is going opposite of fuel prices. Like the last quarter, bringing increases in most European countries, ranging from modest 1.1% in Slovenia to 7.7% in Austria for highways. And as you said, Michael, like in Austria and also in Hungary and in Czechia, it brings tolling intensity or the price per kilometer higher than fuel for these countries. Notable as well, Poland increased its tolling rates by 5% in January and 33% more a few days ago. So year on year, it's a 40% increase on highways. Moreover, the electronic tolling scheme expanded its coverage in Poland by adding 12% more kilometers. So it's a double increase for Poland. Looking further down the line in Europe, the Netherlands is preparing to shift from a vignette scheme to a distance-based toll scheme in July, with great tolling increases to be expected. And the size of the increase is difficult to assess because on the one side you have a time-based system, and on the other side you have a distance-based. But the threshold is 7,000 kilometers, at which there is a price parity between the vignette and the new scheme. So if transport operators are doing more than this mileage in the Netherlands, then the tolling bill will be more expensive.
Yeah, so like you say, that's going the opposite direction to fuel prices. And now, excitingly, we have the latest driver shortage data out here, and I think you're just sharing some preliminary data so far from that survey, but some very interesting findings coming through here. So what's the latest on driver shortages, Romain?
Yeah, and maybe before going to driver shortage, let us talk about transport capacity real quick. So transport capacity is a combination of companies number, vehicle number, and driver number. And quickly on companies, the latest data is showing that the number of road operators increased by 0.8% in the EU, with the staff growing alongside as companies' creation overshoot the number of bankruptcies. On vehicle new registration, the situation differs, with 2025 number declining by 6% compared to last year, due to uncertainties on technology and economic conditions in France and Germany in particular, postponing investment for companies. However, Polish new registration increased by 7% last year, and the Spanish new truck number are mostly declining in 2025, but we saw a great rebound in Q4 compared to Q1, with a tripling of the number. If you look at the details per country, Denmark is an interesting case. So bridging with tolling, Denmark is now using the latest distance-based Eurovignette directive for tolling, promoting the use of zero-emission vehicles, and the number of Danish trucks increased in 2025, despite the fact that diesel new registration decreased, and it has been compensating by new electric trucks. Transport operators are more and more investing in decarbonization solution, with a twofold increase on battery electric truck sales year on year, but questions remain on vehicle supply and market conditions across Europe. But coming back to driver shortage, and more worrisome for transport capacity is the shortage of driver. So as Michael has said, we at the IRU are surveying operators worldwide on their difficulties to find truck and bus driver. We are currently compiling all the data, and I'm showing you here the latest preliminary results. And these data are showing that the shortage worsened slightly in the EU last year, with the number of unfilled positions reaching 444,000 in 2025. That is a 12.1% of all driver positions needed. The situation is notably worrisome for internationally focused fleets, such as for Eastern and Spanish operators. But as for Germany, German operators are also facing a high level of shortages in 2025. Another difficulty for the industry, as Germany is the greatest road transport market in the EU.
Yeah, so no particular improvement in that situation then since the last data. But I think we all had the expectations that the demographics there are working against the industry really. All right, well, thanks for sharing that. We're now going to move on to looking at some of the more granular rates data. And first of all, we're going to look at some of the domestic indexes from Upply here for some key countries, and looking first of all at contract rate development, which Thomas is going to talk us through.
Yeah, thank you, Michael. So here, this is exactly the things I was talking at the beginning. We are in an index graph, 100 base index in January 2017, meaning that if we're looking at the latest rates, for instance, the highest one that we have, 143, it means that we have a 43% increase between December 2025 and January 2017. So this is just for the reading of the graph. What we see here, so the European domestic market in Q4 2025 is a story clearly of multi-speed recovery between the different countries in Europe. While we have the overall European contract index that is increasing, as we have seen at the beginning, we are seeing here a widening gap between the southern and eastern engines of Europe and the western core, let's say, countries. So we have on one hand Germany and France that we can define as the stagnation heavyweights countries, where we are almost flat in terms of domestic contract rates over the year for these two main countries. While we have Spain and Poland, Poland that is not here on the graph, but that is also in the report. Spain and Poland that remain clearly the breakout stars, let's say, of Europe, where we have a Spanish domestic contract rate that is up by 5.5%, so plus 5.5% over the year for these contract rates. Why we have that? So these global figures. Clearly, there is a peak in demand, or there is a high demand in Poland and in Spain also. This is the case for mainly the southern countries in Europe and the eastern parts, not once again France, Germany, or the core countries. For instance, in Spain, it's a plus 2.3% year-on-year jump in retail trade volumes. This is what we have seen in November, so year-on-year in November. So high demand, and this is clearly asking new capacities or requiring capacities, transport capacities on the market. And on the other side, so this is the demand side, and we have the cost part also. Romain talked about it. We have an increase in the toll. even if the fuel is quite a good news, and you're talking about that with the euro dollar also that is more in favor for European countries when it's buying oil in dollar. We still have finance in insurance, for instance, that are increasing more than 4% year on year. Other costs that are increasing, and so with the high demand in these specific countries, the carriers are simply able to pass on this increase of costs and even more to add some margin if the capacity is not available.
Yeah, it's a very interesting situation on the domestic rates there, and I think we'll see that developing throughout the course of the year as well. It'll be interesting to see how the growth affects those rates. But we'll also look at spot now as well. So obviously a bit more volatile than we expect to see for contracts, and Janan's going to make sense of this for us.
Thank you, Michael. What's happening with the domestic spot rates domestically is quite interesting too. Starting with Spain, domestic spot rates are down significantly quarter on quarter by 16.5 points. However, they're still up year on year by 5 points, as last minute seasonal demand and economic growth throughout the year propped the rates up. But month on month in December versus November, rates were down 2.5 points after being on an upwards trajectory since February last year. Italy's rates stand at 111 index points as of December, and that's 6.2 points month on month decline. But it was more stable quarter on quarter, rising by 0.3 points, and it's stable year on year. France is actually the only country with a month on month increase in December, rising by 3.2 index points. Quarterly, though, rates fell slightly by 1 index point, and they're up 0.7 points versus last year, so pretty stable development there. German domestic spot rates stand at 118.7 points, falling monthly by 6 points. While rates remain stable on a quarterly basis, there was a dramatic 17-point drop versus last year. So what's driving these movements? Spain's economy has been the Eurozone's star performer, growing 3.5% in 2024 and 2.9% in 2025. But the economy is naturally cooling. Spanish consumer confidence actually dropped to 76 in November from 78.7 in October, and that's the lowest it's been since October 2023. Industrial production of consumer goods fell slightly by 0.2% monthly in November, and inflation ticked up to 3% in December. All of these factors together are decreasing consumer demand and putting downwards pressure on rates. The auto market as well has shown some mixed signals. So between January and October 2025, passenger car registrations jumped 15%. But in Q4, adjusted Spanish passenger car manufacturing declined 7% versus Q3. And that slowdown is removing some demand from spot rates. In Italy, the economy stagnated in Q3 against expectations of a 0.1% increase in growth. Production declined across key verticals, and high-tech production fell 2.7% quarterly, pharmaceuticals by 5.6%, and motor vehicles took a particularly hard hit as it declined 4.4%. This is also evidenced in some company data, as Stellantis' Italian production dropped a whopping 20% year on year in 2025, and that's the lowest it's been in 71 years. And this decline in industrial demand removes the need for time-sensitive volume procured on a spot basis, and therefore putting some downward pressure on domestic spot rates as well. But looking ahead to 2026, the outlook is a bit more optimistic, and Spain's GDP growth is projected at 2.4% growth. The growing economy and revitalized domestic demand could spell recovery for rates very early in the year, exerting upwards pressure on domestic and international lanes. But broader uncertainty remains, especially in France. The household saving rates remains very high at 18.4%, and consumer spending is more limited by lack of confidence than purchasing power. And this cautious behavior will likely continue to have downwards pressure on rates in the short to medium term.
Yes, it's really interesting, isn't it? This dynamic between what's happening with spot and contract rates at the moment, and the reactive spot rates versus the anticipatory contract rates. So fascinating to drill into what's driving both of those markets. And we're now going to move on to the international lanes. We're just going to look at spot rates for international on this occasion. And again, we see some big changes and movement on the international lanes here. So Janan's going to pick up on some key highlights from this as well.
Thank you, Michael. So starting with Madrid to Paris, spot rates stand at 136.2 index points, declining 2.3 points quarterly and increasing 2.7 points yearly. Warsaw to Duisburg stands at 149.5, and that was a substantial drop of 12.8 points versus last year. Duisburg to Liège is at 139.7 points, increasing 4.7 points quarterly, and that was offset by an equal decline yearly. Duisburg to Antwerp stands at 153.9 points, climbing 15.5 points quarterly and almost 10 points versus last year. And the standout route here was Warsaw to Rotterdam at 163.2 index points. And this route saw the strongest increase of all observed routes this quarter, up almost 10%, 10 points quarterly and 17 points versus last year. So what's driving these movements? In the 9 months ended October 2025, Polish exports climbed by 4.2% to an all-time high of 32.4 billion euros, mainly driven by consumer goods, especially clothing, footwear, and video game consoles. And this export momentum is directly reflected in spot markets prices, with significant increases in rates out of Warsaw to port-bound routes, Antwerp and Rotterdam. And that's reflecting demand for export lanes out of the EU and putting upward pressure on spot prices. Now, on the flip side, while Spain was a European top performer throughout the year, the final month brought a slow end to 2025. Spanish manufacturing PMI dropped 49.6 points in December, and any value below 50 signals a contraction, and it was down from 51.5 in November. And that was the first contraction since April, and that was mainly due to a decrease in both output and new orders. This induced a quick reaction in the spot market, where rates from Madrid to Paris dropped 2.3 points quarterly. Looking ahead, despite the slowdown in Spanish manufacturing and lower consumer confidence, business confidence rose to an 18-month high on an expectation of stronger demand this year. So even though demand towards the end of 2025 was subdued, there was a promising outlook for 2026, and we expect a slight upwards pressure on spot rates out of Spain. However, it's not going to be smooth sailing. EU export market growth is expected to slow overall in 2026 due to high global tariffs weighing on good exports. Meanwhile, imports might grow dynamically, driven by trade diversion. As we saw, Chinese exports blocked from the US market will likely flow to Europe instead. The takeaway is that net exports are expected to have a drag on EU GDP in 2026 before turning neutral in 2027. And for rates, this means limited upside for growth in spot rates in Southern Europe as export volumes remain under pressure, even though domestic consumption provides some support.
Yeah, so a complicated picture, basically. My optimistic side hopes that domestic, or at least internal EU demand recovery in 2026 will lead to a strong year. But let's ask you what you think now, and we'll see, what your thoughts are on rate development for the quarter ahead. So we're going to launch our poll, and you should see that popping up on your screen now. and we'll ask for your views. Now, while you're answering that, we'll just take a look at our sentiment index here. You can see on this very nice smooth chart and see the results from the last quarter as well, where we were expecting still a slight increase in rates as we go into 2026, although actually a slightly lower expectation last time round than we had the quarter before. So, with even though spot rates were quite soft, contract rates rising, there was that expectation that rates would be picking up into the year. So it'll be interesting to see now whether or not you still have that view. Looks like most of you have answered the poll now, so we'll just end the poll and we will share the results and take a look at your thoughts today. So, yes, we can see overall that there is a tendency, 64%, that they will increase slightly. So, a similar view really to the last time round. Thomas, what's your take on that?
Yeah, you're right. I think it's a bit higher than last time, and so it should be it should show a very nice graph going upward. And I think this is the outlook. I mean, if you take the paper, the research paper that we will send to you after the webinar, this is exactly the idea. I will try to summarize our thoughts on that. 2026 should be a year of stabilization for two main reasons. First, if we are looking at the inflation, this is cooling, clearly. We are just in under 2% right now. In France this morning, they announced that we are at 0.3% year on year for this beginning of the year. So, I mean, almost no inflation at all. This is for sure important for business. It's important also for the buying power of the consumer. And then on the other side, we see the expectations of the European Bank, that is plus 1.1% in GDP, plus 1.3% regarding consumer consumption. So it's good news. Hopefully we will match that and the economy will go to these figures. If we are looking in the details, once again, we have the core country like France and Germany that are a bit behind the southern countries like Spain, for instance. But Germany, that had a very tough year in 2024 and 2025, seems to be coming back. And so the main question will be to have a look at 3 points. First, we have the volume recovery. Romain was talking about that. We expect an increase of 0.6% regarding the volume ton kilometers. It's reaching the volume that we had in 2021, so almost at the same level. While we have a driver shortage that is important in certain countries, less important in others. But if we are looking at the driver shortage and the map that you were showing, Romain, this is in the top countries where we have carriers right now. So it might be an issue. And if we have demand that is coming back, volume that are not here, or carriers and trucks that are not here, it will put a squeeze directly on the balance between offer and demand, and might have an impact on the price. On the other hand, if we're looking at the cost, we talk about the increase in cost regarding financing a truck or the insurance part. There is for sure the tolling part. There are the ETS2 that is for 2028 now, but that will come. That will have a significant impact in terms of cost per euro kilometer. The only good news, let's say, is for now that the fuel is not that high and that will certainly stay low. So this is the main takeaway, in the sense that we try to highlight the things that you need to have a look at. Regarding contract rates, we think that the demand recovery and the driver shortage, or all this capacity, the constraint that we have in capacity and the costs that are still high, will certainly go on a slightly upward trajectory regarding contract rates. And we are seeing right now on the market shippers that secure volumes at a quite good price, let's say, over the past quarter. Regarding spots, we are expecting more seasonal spikes that in 2026, more seasonal spikes compared to what we have seen in 2025. And I think that's it. The big uncertainty is the same than in 2025. The geopolitical wild card, let's say. We are in a space right now. You were talking about Greenland. We have many things that are popping every week with a kind of risk war, economic war, real war. So for sure, this is the big unknown. But yeah, that's it. That was the big takeaway from my point of view of this report for 2026 that has been written by our experts.
Thank you, Thomas. Yes, that's very interesting views on the year ahead. So that brings us actually to the end of our presentation. Now we'll answer as many questions as we can. I can see that a lot of questions have already answered by the team in the background. So thank you, team, for responding to those. But we'll take some more now, and I can see. Yeah, so maybe we'll tackle a couple of sort of methodological ones to start with. So first one for you, Thomas, I think, is asking, could we have an overview of bulk transport as well? Would you just like to answer that one, Thomas?
Yeah. The answer is quite straightforward. Yes, we do. We had another question also regarding LTL or regarding the capacity of comparing one way and the other regarding a certain origin and destination. For sure, everything is available in the data of Apply. I mean, or at least this part, the bulk part, the reefer part, the inbound, outbound from a certain city. Just that we need to select some of these data for the webinar, for the 1 hour and a bit less than 1 hour the webinar. But yes, the data is available.
Yes, we do have to pick a very limited amount just to go into this, otherwise we'll be here all day. But there is masses you can dive into, of course, on the Apply database. So that's right. Okay, and maybe one for you, Janan, here. We do see limited interest of automotive carriers to conquer remaining industries, while it seems there should be substantial excess of capacity. Could you confirm if you see the same, and what's the rationale for that? Janan, I guess that to you.
Yes, so we see the same. Theoretically, there should be excess carrier capacity coming out of automotive. The thing is, automotive carriers are highly specialized with their dedicated equipment, so it's difficult to pivot to general freight. Plus, the sector shows mixed signals. While Stellantis did drop down 20%, BMW and Volkswagen saw growth in certain segments. So most automotive carriers are choosing to wait for recovery rather than retool for other industries because just the structural barriers of switching are too high.
Okay, thank you, Janan. One for you, Romain, I think. Is there any perspective on e-trucks and biodiesel usage for the cost and the demand? Oh, you're muted, Romain.
It happens. Sorry. So starting maybe with HVO, what we see is a great interest of transport operators to use this fuel because the impact on the TCO is quite minimal and the CO2 emission reduction is about 90%. Now, the big question is on the feedstock available and being sure that the CO2 reduction that you want to report has not been used before. So you have a system of credit to be developed. What we can expect is a greater use of HVO in the coming years, but the EU can run out of it by 2030. So we see it more as a transition technology. Regarding e-trucks, so we are doing at the IRU TCO analysis, comparing e-trucks with diesel and HVO. We see e-trucks getting less and less expensive, notably in Germany, in Poland, thanks to great incentive, and in France, if you are able to charge them, which is a big question today for transport operators because they are facing difficulty not only to find a public charger, but also to set up a depot charging charger. But the one who can really leverage depot charging can really have a great TCO. But then there is a question of operational range and if you can integrate a logistics scheme without any disruption. But we see the number of BEV growing slowly. it's quite a positive trend, and let us see what the future will bring.
Yes. Well, there's a big expansion of charging networks out there now, so hopefully we'll see some improvements on that over the course of the next year or two. Okay, we've had a few questions, I think probably for you, Thomas, around comparison to rail and intermodal or comparison with other transport modes. Would you just like to answer that?
Yes, I've seen indeed 3 questions regarding transportation, globally speaking. This is on our roadmap on the Upply side, and we are collecting data right now regarding rail intermodal transportation to a benchmark that is as precise as the one that we have today. The big question, sorry. The big point is that we have today people that are comparing the two, and usually the price of rail is not that far from the one of road transportation.
All right, thank you, Thomas. All right, and I think we've had a couple of questions as well, just looking at the dynamics between the spot and the contract rates again, and how they can be different. So particularly one example, looking at spot versus contract rates in Spain, and how there's such a or why there would be such a big difference. So Janan, I don't know if you'd like to try and tackle that one for us and try and explain some of the different dynamics at work there. You're muted, Janan. Yeah.
Yes, of course. So naturally, the spot rates are more volatile, especially during busy season, and they are more sensitive to consumer demand on the market rather than longer term commitments. And so, even when business confidence is high, spot rates could be low due to there not being demand in the moment.
Okay, thank you, Janan. There's another question for Romain here, I think. Can we continue to see help from government on the use of HVO, as was the case in Italy in the coming years? Romain, would you like to tackle that one?
That's a very good question. And when you look at the excise duty and the CO2 component of the fuel taxation today, Italy is at the forefront to support this type of fuel, but it is linked to the fact like they have a lot of refineries doing HVO nationally. We don't see the same picture for other countries, and I don't expect excise duty to be lower for HVO. I want to add something more is fuel provider today has an incentive to lower HVO price, because when you buy HVO, it brings them CO2 offsetting on the objective. And as the HVO consumption will increase, it will compensate diesel sales, and so there will be less and less CO2 for them to compensate. So you can expect the incentive to go smaller in the future, which would be quite a bad news for HVO prices at the pump, because today the cost of production is much higher than the price you see today at the pump.
Okay, thank you, Romain. We had another question asking about other expenses other than fuel and tolls and drivers, asking about insurance, maintenance, equipment prices, and how does that affect the prices in Europe, referencing that it's a big factor of increases in Mexico and Latin America. Well, I think in Europe, I mean, we do have data tracking those other cost factors, and they obviously go up and down, but the cost of drivers is so high that often salaries is a determining factor on what happens with pricing, which is why we cover so much about capacity and driver shortages in this report. But also we've seen such a lot of change in fuel and toll prices in the last year that those tend to dominate the sort of changes we're seeing in the operating costs of running a truck. So, those things are important, but because of some of the other costs being so high in Europe, and so changing so much at the moment, they're more important in the European market, really. And we also had another question, I think, about the sort of general changes in the market that might be brought about by adoption of electric trucks. At TI, we did publish some research a couple of weeks ago, actually, on that, and really looking at obviously adoption rates, but also what it might mean for transport practices in Europe. So, looking at whether or not when we get to a certain level of adoption, whether we would actually be looking at changes in the way that networks work, average trip distances to accommodate the range of these vehicles, and flows along major trunking routes where charging networks are available, all these kind of factors. So, to what extent would electric trucks reshape European transport networks? There's some good thinking around the future in that paper. But at the moment, I think a lot of the time is taken up by companies seeking to find, which transports within their networks are suitable for electric vehicles rather than changing the networks and then adoption there. So that's, at the moment, I think the focus short term, but like I say, there may be some bigger structural changes coming about over the longer term as well there. Okay. I think we dealt with that question. Yeah, there's a couple more questions about the comparisons between spot and contract rates. I mean, I think Janan dealt with that partly, but Thomas, I can see that you've sort of put your hand up to answer that question. So is there anything else you'd like to add on the comparison between spot and contract rate development?
Yes, we had some questions regarding spot and contracts indeed, and it's always a bit tricky to compare both of them, but usually spots rates are a bit in advance regarding contracts. For sure, one big thing is for sure, but this will be not a big news to anyone that spot is more volatile, for sure. And then the volatility of the spots usually come a bit forward just before an increase or decrease of the contracts. This is the main takeaway. This is not for sure true every time, but yeah, this is the comparison that we can do.
Thank you, Thomas. Yes, okay. All right. Well, I think that brings us to the end of the session today. So thank you very much, everybody, for joining. It's a pleasure to have you with us to discuss these issues, and we really look forward to seeing how the market will develop over the course of 2026. Now, if you want to carry on the conversation, we'll of course all be happy to hear from you. So you should be able to see the contact details for each organization on the screen there. We'd be very happy to hear from you. And all that remains to me really is to thank you for joining us and our panelists as well. So thank you, Janan, thank you, Romain and Thomas, for your input today and your insights, valuable as always. And we look forward to the next session in Q2, the Q1 report. All right. Thank you, everyone, and bye-bye.
Goodbye.
Thank you.